For everybody being here on Saturday. I love these events. When markets are closed, we kind of kick back, talk the markets, make this as interactive as we can. So make sure, if you have a question, please do go ahead and ask it. If I miss it, the GoToWebinar tends to, scrolls down. So the questions roll off at a certain point. But make sure to ask it if it's something that you really need me to answer. So feel free to ask questions and let's get started. So what we're going to talk about today is kind of an option strategy guide to help you know when and how to use which strategy for the best trading results. So, options can be very confusing, but hopefully this is a workshop that will kind of demystify a lot of that, for you. So a little background on myself. I, started my trading journey back in the 80s on the oil side and was fortunate enough to get my foot in the door at a company called Coastal Corporation. Was a big, oil refining and trading company out of Houston. And they actually had a training program where they would train you to trade oil. So I was able to get into that program, and this is kind of right out of college. And it was a pretty cool program. They would sit me down to their refinery down in Corpus Christi for about 3 months, just kind of learn the process of oil going in, the products going out, how the tanker chartering worked and scheduling crude, all that stuff. So we ended up in the scheduling department, and that was a lot of, really enjoyed that, going into the tanker cargoes and chartering ships and doing all the kind of the operations there. It was really interesting. So eventually, though, got into the trading desk. They sent me out to Singapore for a couple of years where I traded products. And then ended up with a company called Transworld Oil for about 17 years. They were the largest at that time oil trading company in the world. So it was Fibro, Mark Rich, Transworld, and was with that company for 17 years and ran the trading group out for 10 years out of Bermuda. So really great, fantastic experience. And that's where I first started trading options back in 1987. So here was a little bit more hair back there in 88, 87, and but still, on the option side ever since. So we're going to talk about options and kind of a guide to help you, know which strategy to use, when and how, and when to use it. So let us get started. So the following presentation is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. Now, the secret to trading profits, in my opinion, really come down to the use of options. So trading, is a business of probabilities, and to be a successful trader or investor, controlling your risks is what's going to really win the game. So by knowing and better understanding how to manage and control your risks, it's going to make a dramatic and positive difference in your trading or your investing performance. And one of the best ways to achieve this is through the use of options. So, from day trading or swing trading or long-term investing, there's no better way to trade or invest for unmatched greater returns than through, and with much less risk than through the use of options. So by trading options, we have many more advantages when we use options than for, trading stocks, but they can be a little bit confusing and sometimes kind of debilitating to traders or investors unless you know which strategy to use, when and then how to use it correctly, based on the market environment you're trading. So I call this debilitating trading confusion the option strategy confusion, or OSC. So, many traders suffer from it. So let's just try to get through it and demystify a lot of it for you today. So what we're going to talk about is what you're going to need to know to successfully trade options, and no more OSC or option strategy confusion. So step one is to understand how option pricing works. So we want to do this in order so that we can maximize our trading profits. One second. Can everybody hear me okay? Mic test. Got one person that said they couldn't hear. Okay, good. So they should be just coming back in, go out, come back in. Okay. All right, sounds good. So, you want to understand then how option pricing works in order to maximize your trading profits using options. So when we're trading options, the most important option factor really comes down to understanding the concept of time and volatility and their impacts on the price of your option. So the time value component, or the extrinsic value of your option, this is the premium that a rational investor is going to be willing to pay over its current exercise value, the intrinsic value, based on that potential of the option to increase in value before it expires. So the change in this value of an option based on time decay, we can measure this using the Greek theta. And that's the other really great thing with options. We can use the Greeks to give us, theoretical measurements of, where a price will be based on certain conditions that happen. So the Greeks are one great way to, understand option pricing. And the first one we want to really deal with is theta. So when we look at time decay, it always works against buyers, but it's going to benefit the seller of an option. So why is this? Because option theta is going to either have a positive or negative theta characteristic to it. So if you think about it, all long stock options, so if you're long a call or a put, they're going to have a negative theta value. So that's going to indicate they're going to actually lose value as expiration draws near. So if the market price you're trading is kind of churning sideways and you're long an option, it's going to start going against you with that negative theta value. Now the other side of the coin is if you're short that call or short that put, you're going to get a positive theta value, which indicates that the position is going to be gaining value as expiration draws near. So these are things that you want to understand as far as the option pricing components, how they work for you and how they work against you. Now, many option trading strategies are going to sell out of the money options on top of buying at the money options or in the money options in order to offset this negative theta. Now, what this does is going to result in a lower rate of your time decay, and it's also going to lower your capital at risk of your trade or your option spread. So these are, trade strategies such as maybe a vertical bull call debit spread, or vertical bear put debit spread, or butterfly, or a long condor spread. So these are strategies that will take advantage of not only buying options, but selling options to reduce this theta decay component. Now, when we look at the volatility price component, this is based on implied volatility, and it's expressed as a percentage of the stock price. So it's indicating a 1 standard deviation move over the duration of your option cycle or series. So in theory, a stock should end up within 1 standard deviation of its original price, statistically about 68.2% of the time during its option cycle. And this is started out measuring based on an annual type basis, and then we break it down to days expiration. So this is a theoretical probability or forecast of a security's price range, and it should be used as part of your process for selecting the highest probability price targets for any trade taken. So this is a really first step that we really want to understand when we're trading options, is to use this volatility price component to help us forecast price. So when we look at the value of the option, and then again, it comes down to the basic components, which will be your time value times the implied volatility times the underlying security value, the intrinsic value. And once you know these variables, then you're going to be ready to price out your option, know what the option premium should be, and then start the trade out. So let's go through a kind of an example of this option pricing model and how it works. So every Thursday we have a new options, weekly option series. Now most option contracts today are going to have weekly options. So when we start out on a Thursday, we're going to start with 100% time in the value of the option. So we have the time value component times the implied volatility times the underlying security value, that intrinsic value, and that's going to give you the price of your option or your option premium. So we're going to keep the intrinsic value constant at 1, so you can see just how this time and the implied volatility flow through. So Thursday, that first day of the weekly series coming out, we've got 100% time, plugged in the number of 300 for the implied volatility. This is constant, so we've got an option price of $300. Now you'll notice here, Monday after the weekend, etc., it didn't take a break. So at the end of that weekend, we come in Monday and half that pricing component cut in half. So we're only now 50% left of the time value component of the option. And even if we spike the implied volatility in this example to 800, it barely moved up the price of the option. So your premium here is 400. So let's say you've got the implied volatility is only 200, and now your pricing component time value is cut in half. So your value of your option would only be $100. So you can see at the end of the day, when we get into the expiration of that weekly option, both time go to 0 and implied volatility go to 0. So we want to be aware of these two pricing components, how they work, and take advantage of it for our option pricing. So that's the beauty of options. We can use spreads that would not only buy options but sell options against it to take advantage of this time value or time decay and the implied volatility. So these are what we're going to talk about, the different types of ways that we can structure trades to take advantage of these two option pricing components. Now let's take a look at how time is traded. So we can actually trade time. We can trade time by selling time to take advantage of option time decay. So if you think about an option, selling options, we're in essence selling time and volatility. And you can also think of an option, a good way to think of an option is like a coupon that you get at a store. So you look at that, you're in the checkout line, you look at that redemption value of your coupon, and you see you have to use it by next week in order for it to still be good or valid. So it's just like an option, an option series like a coupon. At the end of the series, it's no longer going to be valid. So you want to be able to take advantage of the option series you're in, like a coupon, something you get at a store. So here's another graphic example of time decay and how it kind of really accelerates. So when we start out, further out in time, so let's say 120 to 90 days out, if you're a buyer, you sometimes might be here, the gift of time is your friend when you're buying an option, because the further out in time you get, the less the time decay. It starts out very, very small. Now, when you get 30 days out from your expiration, so that day zero when options expire, that's when it really accelerates. And so 30 days out is kind of the sweet spot. And then you've got these weeklies that are really accelerated. So kind of time decay on turbo time decay, so you get these weekly series. And now we have the, index options, SPY, the Russell QQQ, they'll have options series that expire like every day. So a lot of different creative things we can do with these options that have these weekly option series that we can play. So that's the takeaway here. You can see that accelerated time decay and how it really starts to get going. Now, the third step is trading the probabilities. And this is what the market makers don't want you to know. And this is based on, again, talking about the probabilities of price, where it will be over the price of your security time frame that you're trading. So let's take a look at what this is and how it works. So when we look at the option markets, the option markets use mathematical market probability statistics to price the movement of an option to its expiration. So by knowing the probability of your underlying security finishing within a certain price range by its expiration becomes key to determining then what options you're going to look to buy or sell, and then what option strategy that you should use. So this forecast is what we refer to as the implied move or the implied expected move of your stock or security. And what it's based on is based on just kind of a theoretical estimate of that one standard deviation move of your underlying security by its expiration date. So when you think about one standard deviation, think of that being a kind of a normal move up or down, one standard deviation. Now, when you get outside of one standard deviation, that's when you're starting to get not normal, but kind of more extreme movements. So when we look at this, this distribution curve down here, it really kind of illustrates it more clearly. So if you're looking to sell an out of the money option, basically one standard deviation out, you're going to start out your trade theoretically with an 84% theoretical chance of winning. So this is based on, your option deltas. So if you think about a delta of an option, it's equivalent to 100 shares. So the max value of a delta would be 100. Now, so that would be like you owning 100 shares, right? So one option contract is equivalent to 100 shares. Now, if you were to sell an outside point right here, in this example, this is the at the money price 500. The expected move in this example is plus or minus 4%. We're going to say 4%. So that would put the movement to the upside would be 520, to the downside 480. So that would be a normal move. Now, this outside point is basically going to have a 16 delta. That's your kind of one standard deviation point. So this is 15.9. Then if you look at that, then the probability of price going above 520 gets really small. So you've only got then a 15.9% chance that your 520, the price will go above 520 into the expiration, or the other way to look at it, or below 480. So this outside point is what we call the 16 delta. Okay, so that'd be a 16 delta or minus 16 delta. So when you look at this and you take that 16 delta from your option max delta of 100, that gives you 84, right? So theoretically, if you were to sell this outside point 520, you're starting this trade out with an 84% probability or chance that price will be below 520 at expiration. Or if you were to sell that 520 put, then there's a 84% probability that price will be above 580. So that's one way you can look at it. And then if you were to sell a 5 delta, which is like 2 standard deviations out of the way or out of the money, you've got a 95% probability that price will be below that short strike, or 95 that will be above that short strike of a put. So these are the ways that you can look at this from a kind of a probability standpoint. And again, it's theoretical, but that's why sometimes a lot of times you're going to hear when you're selling options, these are kind of probability trades. So we want to understand that and then put it to our use and put it to our benefit. So here's another way to take a look at it. So this is your option delta and the probabilities. So here's a good example with Apple, and you can see Apple here trading at $190. All right, so then you look at this Apple, and you can see here it's got 28 days to expiration. All right, so you could look over here, your option pricing model, then it's going to put in the at the money price, $190, days to expiration, 28 days, and then it's going to look at the implied volatility, and that's a changing number, during the day or each and every day. So right here, this implied volatility of this option series is 29.13. So what that's going to give you then is going to give you what we call the implied expected move, which Thinkorswim then gives it to you right here. So this would be $12 up or down. That's your expected move. And that's kind of a 1 standard deviation price point. So, if you look at your price trading right here at the money, $12 up would be right here, kind of that 1 standard deviation price point here, or $12 down right here. And so your range is that 1 standard deviation range in there. So the other way we can look at this though is you look at your deltas. Okay, so if we look here at the delta here to kind of explain this in even more detail, if you look at the money 190 right here, you can see it has a delta of 52, let's say 50. So what this is saying that there's a probability of 50% that the price could be at 190 or below, or 50% 190 or above. And then if you go then further out of the money, let's say we go to the 215 strike here, and you look over here to the delta of that, you can see the delta is 0.05. So the other way to interpret that is that there's only a 5% chance that the price will be at 215 over the next 28 days. There's a 5% probability that it will be at 5%, or the reciprocal of that is what we call probability out of the money, is you can see here it's 95. So, that 100 delta less that 5 delta gives you the probability out of the money of 95. So the other way to look at it is the 95% probability that price will be below 215, over the next 28 days. So you can then interpret this information to say, wow, okay, let's say I was buying that 215 strike. Well, you're taking a lot of risk. There's a low probability that price will get to 215. But if you took the other side of that trade and you sold the 215 short strike right there, then you're starting that trade out with a 95% probability or chance that that will be a winning trade and price will be below 215. So this is how we use option delta and the probabilities, to kind of figure out a forecasted price range, and then we can back into what option strategies might be the best to use based on this information. So then by using this kind of analysis, it's going to really be a useful tool for you to use for determining price targets to trade against. And it's also very useful for setting up your hedges. So if you think about it, let's say you're long an option and then all of a sudden markets start to unravel, and you want to sell, an option against it, well, you can use the option delta to give you kind of really fast probability of, that price point that you're maybe selling short to hedge. You can see the probability of maybe the price getting to that short strike, and that gives you a better feel for the hedge that you're setting up. So you can see then based on the math of these kind of probabilities, you can see that approximately 70% of options that are bought out of the money are going to expire worthless. And based on this, it's a really good idea for all traders or investors to consider selling options as well as just buying. So when you're starting out with option trading, it's more simpler to think buy low, sell high. So most people start out by buying options. which is a great thing to do because you make a lot of money. But what you want to be able to do is realize the other component of the option is the sell side and what the advantage that gives you. And then the best is to marry the two together so that you're using option spreads where you may be long an option and you're short an option against it. And then you can create a lot of these really great structures that can give you a better return on less risk by using option spreads that are long options and short options as a spread. So when you combine these two together, buying and selling options, it really creates an unmatched option trading strategy that you can use that's going to provide you greater returns and greater returns on much less capital that you're putting up at risk. And that's what's going to really win the game for you in the long run on your trades or your investing that you're doing when you're using options in order to do this. So let's take a look at step 4 is selecting the perfect option strategy. So let's take a look at what those strategies could be and then how to select the appropriate one for the market you're trading. So this is what I call kind of the process. So first off, you identify, okay, so what's going on with the market cycle? Okay, you want to identify that market cycle you're trading. So do you think the market's going to go, it's going to go up, it's going down, sideways, or have no idea? So you want to be able to make some kind of idea on your market cycle. Is it cycling up or down or sideways? The second thing you want to do is what I like to do is identify the chart pattern that you're trading. So I've kind of put together 5 very selective what I call high winning probability chart patterns. And so I look for these chart patterns, and that will dictate also what type of option strategy might be the best to use based on the chart pattern that the market's trading. And then you want to look at your time horizon, your trade duration. When are you expecting this trade to make money? So are you looking for this to be more of a day trade, or are you looking at it might make money tomorrow or next week or a month from now? So you need to understand your trade duration in that time part of the equation of your option that you're looking to buy or sell. That goes into your option calculation. All right, so that's step 3. Now, 4 is your capital at risk. So based on your market condition, you want to kind of quantify the market conditions you're trading. Are you trading a really low risk market or medium or very extreme market conditions? So the higher the element of risk goes up, the more tighter or you want to really get your risk more under control and tighten it and reduce that risk. So it's a big part of the process of then what option strategy to use based on the market conditions you're trading. So extreme high risk or medium or low risk is going to help you dictate, what's the better option strategy to use under that kind of condition. And then 5th, your objective. Are you looking for kind of more of an income type of strategy, making a consistent income, or are you looking for profits, hedging, or capital gains type trades? So all these will go into the process of then selecting the best option strategies to use, when to set those up, and then how to use them. So let's take a look at the different strategies that I like to really go to. So we're going to cover these and kind of go through them briefly here today so you get an idea. So we're going to talk about long calls or puts, vertical debit spread, the vertical credit spread, butterfly, long condor, the income calendar, and the counter diagonal. So these are strategies that are kind of what I call my go-to strategies, and then we can break these down and we can apply these different strategies based on the market condition we're trading, the capital at risk we want to put up, the market cycles, etc. All right, so these are going to be ones that we can put in place, but then these are going to be based on the other parts of the kind of process. So when we look at long calls or puts, these can be used for your day trades or swing trades. And so they can be set up for a trade that lasts 1 day or 10 days or longer. Now, generally, just kind of a rule of thumb, when you're buying calls or puts, typically you're going to look to buy at the money, a 50 delta, or maybe go a little bit more in the money, a 70 delta strike. So they're going to be a defined risk trade, and these are going to provide you unlimited potential upside profit. So if you bought a call, you've got unlimited profit to the upside. It puts almost the same. But the other side of this is they're going to cost you more, plus they're going to have a lot of time decay, which can really erode the option price. So the other side of that is then maybe set up a vertical debit spread. So these can also be then used for swing trades or longer term trend trades. They're going to be defined risk. They're going to lower your capital at risk, and they're going to lower your time decay, and your profit upside is capped. So the long calls or puts unlimited profit, but they're going to have time decay and they're going to be more expensive. But we can offset a lot of that by using what we call the vertical debit spread to offset some of the theta decay by selling that option price component against it, creating that spread. Then the other one is what we call the vertical credit spread. So these can also be used for day trades or swing trades. Best used when your implied volatility is higher because you're going to bring in more premium when the implied volatility is higher. So they're going to be a defined risk trades. You're going to take advantage of that time decay and sideways price action, but your profit upside is going to be capped. And these are very small profit kind of a return on your capital at risk. So these are what we call the probability trades, and you're maybe going to get 25, 30, 40% would be your max kind of return on a credit spread. So when we look at the vertical call debit spread, here's an example where you would have your capital at risk is your debit paid, in this example of $300. So for example, here, your debit cost is, let's say you're long this call here. So this is like on the NASDAQ 100. So you're going to be long this 1010 call right here, and then you're selling a call against it to reduce the capital at risk and reduce your theta decay. So you're going to be selling that 1020 strike. So if you look at that, that's a $10 spread width, which would be $10 times 100 is $1,000 spread width. So in this example, the cost of the trade is your debit paid of 300. Now the difference is your potential profit. So if you were to get this at expiration where it closed above the 1020, you're going to keep the difference of this trade, which would be $700. That'll be your profit, and that return on that 300 at risk, that's a 233% return. So the other way to look at it, you've got this positive risk ratio where you're risking $1 to make $2.33. So that's the beauty of a vertical call debit spread or a put debit spread, all right? So we're reducing our capital at risk, we're reducing our theta, and we've got a positive risk ratio. So that's a typical vertical spread, debit spread. Now the other side of that is the vertical call credit spread. So in this example, it's using the same underlying security like NDX, but in this example, you're selling your credit received as your profit. So you're selling that call, the 1020 call here, and then you're capping your upside risk in case you're wrong and it keeps going up. So you're buying that call there, the 1030. So again, a $10 wide spread. But in this example, you've got that spread width, it's a $1,000 spread, but you only brought in your credit of $200. That's your max profit. Now your risk though, you're taking on $800 of risk to make $200. So that's what we call a negative risk ratio trade setup. So in this example, you're risking $4 to make $1. So this would be a 25% return. So, if you're just starting out with options, you would say, well, why the heck would I ever do that? And this comes down to what we call a probability trade, because like I mentioned earlier, if you were selling that 16 delta, that you're starting that trade out theoretically with an 84% probability of this being a winning trade, the price would be below that short strike in this example of 1020. So that's why, you're getting that less return because you're theoretically taking less risk because you're so far out of the money. So it gives you that negative risk ratio. Now the next kind of combination, which is a really good one, is what we call the butterfly spread. So very unique strategy that combines buying and selling options. So it combines your vertical debit spread with the vertical credit spread. So it gives you defined risk. It's going to be a debit cost trade, takes advantage of your time decay and the implied volatility that's going to go to zero at expiration. So we take advantage of that. These are going to give you a positive theta, so no time decay with the butterfly. Used for really good for directional trades or non-directional trades. 1 day up to 2 weeks is kind of the sweet spot. When used correctly, it's going to give you, of all the different option spreads, the butterfly is going to give you the highest return on capital at risk of any option strategy, option spread strategy, and also great for hedging because with the butterfly, you're a vertical debit spread with a credit spread, so you can leg in and out. You can start with a debit spread, add a credit spread. You can start with a credit spread, add a debit spread, or you could just do it all at once as a butterfly. So a lot of flexibility to the trade, and that's what I love about the butterfly. So here's an example of a butterfly and how cheap these can be. So here's an example. So let's say you're long that call here, you started out, and then you sold that call here. So you started this with a call debit spread. But now you want to reduce your risk more. So what you could do, sharing that same short strike of the debit spread, you can sell another call, buy a call here. So now you reduce your risk in this example to $100. Now, if it goes out, which we call this the tent, the top of the tent, that's going to be your max profit, but you have this profit zone all the way in between. So you've gone, let's say you did this debit spread for 300, and then you added that credit spread here for 200. So now you've reduced your total risk down to 100. So if you went out here, max profit in this example, between the spreads, it's going to be $900. And your risk though now is $100. So you can see the potential here is huge as far as the risk reward of this type of trade. So that's a long call butterfly, just kind of a simple example that you can look at there. Now the next one, which is kind of the cousin, what I call the cousin of the butterfly, is what we call the long condor spread. So like the butterfly, it's going to combine buying and selling options. So again, it's going to combine a vertical debit spread with the credit spread, but does not share the same short strike of the vertical debit spread. So it's going to move the vertical credit spread short strike further out. And this is going to then provide you a bigger profit zone. But it's also like the butterfly, going to give you a positive theta, no time decay, great for directional trades 1 to 2 weeks out. Also going to give you a higher return on capital than if you're just doing a credit spread. And again, great for hedging. So, you know, your butterfly look like this, but with the condor, you're separating the spread out. You're not sharing the same short strike as the butterfly right here. So you're getting this wider profit zone. So another really great way to reduce your risk, but also have a trade setup where you're taking advantage of selling that additional option premium to reduce that capital at risk and reduce your theta decay. So it looks like this. And again, we can do calls or puts, all right? So you could be long a put here, short a put here, right? So you've got a put debit spread. Instead of doing it converted to a butterfly, we separate our, you know, short strikes out, and we sell another put here, buy a put here. That'd be like a bull put credit spread. Now we've got this put condor, or we can do with calls. So a lot of flexibility. We can leg in, leg out, things like that. So great flexible structure for your trades, and also lowers your risk on the trades you're putting up. Now the next one is another really favorite, is what we call the income calendar. So it's a more like a favorite medium to longer term non-directional strategy, but we like to use it at Power Cycle Trading as what I call kind of a target trade. So the income calendar is basically a neutral strategy that's going to profit from your underlying security remaining stagnant or trading within a tight price range. So the profit comes from the difference in your rate of premium decay and the implied volatility differential spread between the near-term short option that you're short and the long-term option that you're long. So with this one, you're going to be using two different option series, but you're going to be short and long the same strike. So we'll go through how this works, and you're basically, the theoretical part of it is you're taking advantage of that time decay and volatility as it goes into your expiration. Now this is possible because your near-term option premiums will always decay faster than the long-term option premium, right? So that theta decay really accelerates the closer you are to expiration versus your long dated. So great strategy when you expect a stock or security to stay stagnant within a tight range, and then you can produce income from that time decay. Also, again, what we use for what I call the target range bound trade. So, you know, a strategy for a market condition when you want to keep your long-term position intact for a stock or ETF. These are great for ETFs if you're expecting that potential breakout either upside or downside in the future. But, you know, in the short term, you're thinking, okay, the price is going nowhere for a while, but then eventually will break out. So we could take advantage of that kind of sideways price action and receive the premium from the short dated option. And that's going to then basically amortize down your long dated. So it's a really great strategy to kind of put you in place for a bigger move up or down that theoretically you think is coming, but it's not quite there yet. So what this does, it allows the position to get paid while you wait for that long-term position breakout. So here's what it looks like, the theoretical part of it. All right, so this is 30 days out and 60 days out, but we can use weekly options. So let's say we did a weekly option here in this example where we're 6 days out and 3 days out, kind of related, or you could do 30 days and 6 days. So what we're doing here is you're gonna, let's say we short an option with the 100 strike here. So we're short that 100 strike right there, okay? Now the expiration of that 100 strike is 3 days, but then you're long against it as a spread, you're long the $100 strike 6 days out, okay? So what you're doing in the perfect trading world, if the market doesn't go anywhere, what happens? This strike that you're short here eventually is going to decay to 0, right? This one's going to decay slower, and you're going to keep the spread difference as your profit. Plus the volatility difference is also something you can play off of. So that's kind of in theory the way it works. Now, what we're going to, what we like to do, what I like to do is if you've got a target, let's say you've got, an ETF or a stock or whatever, and let's say it's trading right here at $100, and you're looking for not a big move, but you see there's a really big resistance area maybe up here at the 105 strike. So this is where we can do a target trade. So what we can do is we can go out and we can buy a longer dated, the 105 call, and then sell against it, the short dated 105, and we've created this calendar, and we're targeting that 105. So if it gets to the 105 target, that's where we make our profit. So these are, a lot of things we can do, flexibility. And then the other great cool thing about it is if we think, okay, now 105 is going to break out and we think it's going to really roll to the upside, we can close out the short dated 105 strike and roll up our strike maybe to 110 on the short side or 120 and just keep working the trade up, as it's trending, or down as it's trending. So we can do this with calls or puts. So great strategy to give you that flexibility. Now the other part of it is the counter diagonal. So this is another favorite medium to long-term directional strategy. But this one gives you kind of the diagonal spread component for speculating on trend, and also great for hedging. So basically it's a vertical diagonal debit spread where the long option leg expiration is going to be further out in time versus the short option leg, which again is going to be closer or set closer into time to take advantage of that accelerated theta decay. So use when you want to take advantage of your short-term weakness or strength that you think is going to eventually go away in time, and then revert to your cycle either back up or down. So really great trade strategy when you're coming into a market where it's had a big sell-off, big move down, start to stabilize, but it could take a while for it to eventually then break up. So this is a strategy that we'll use for that. So we could do a long call counter diagonal and sell that short premium, and it may take a while for this thing to finally churn up and turn up. And so another thing, sometimes these are called what we call a poor man's covered call. So instead of buying the shares for your underlying, we're buying the out of the money, further out in time option. So sometimes it's called the poor man's covered call, but I call it the smart man's covered call, because you're not buying the option, you're not buying the shares, which are going to, have to put out more capital. You're buying the option, which is going to be a lot less capital intensive, and also then that's going to reduce your risk, right? So if you were to buy 100 shares of, let's say, Microsoft, and it costs $200, you can see the difference between buying 100 shares of Microsoft at 200. So that's going to be 100 times 200 shares, or 200. That's going to be $20,000 that you would pay to buy, 100 shares of Microsoft. But we could do the same type of trade. Maybe we could just buy one option contract equivalent to 100 shares, and that might cost $200. So the huge difference between using the shares like a covered call versus the counter diagonal. So that's just kind of one little, way to think about it. So this trade construction then takes advantage of that accelerated time decay characteristic of that front short dated option that's going to decay at a much faster rate than your back long dated option against it. Plus, you've got the positive implied volatility differential between the two option series. So if there's a positive volatility skew, that's also going to give you the benefit from selling that short dated, because you've got the higher volatility that you're getting more premium from that. So that's what we call positive skew that we can take advantage of. Now, with the calendar diagonal, though, this gives you that additional vertical spread component. And that's what really adds that really great directional element for greater profitability. So this is a setup that we can use to buy options at a discount while we're waiting for that direction to kick in, either up or down. So we can use calls if we're looking for an upside move, or puts for a downside move with these two type strategies, the calendar or the calendar diagonal. The diagonal could also be set up as a credit spread too. Yeah, initially you can look at it as a credit spread while you're waiting, right? So it's a credit spread while you're waiting, basically. Now the way to look at this, for me to understand it the best, is let's say next week's expiration is 12 May, right? 12 May is the next Friday's expiration. So if you were to do a call debit spread, that's going to be in the same series. So your long call, and then your short a call, right? And it would be, let's say we're doing this in the 12 May series. So your long call and your short call are in the same series. Now the counter diagonal, if you do calls or puts, instead of having the same series, we're going to go further out in time to buy the call. So here we're going to be long this call. So here we're long, let's say the $100 call, and we're short the 105 call here. Now, if we're doing this as a counter diagonal, what we could do here is we're selling the short call here, the 105, let's say, and this would be maybe the 12 May. So, you know, the duration next Friday. So that's going to be short duration, but this longer call, maybe this is out to the 6th June. I'm just putting that in there. So you're long the 6th June call, 100 call here, short the 12 May 105. So you can see it looks like a call debit spread, but we've got two different option series. So we've got this short option series here, and that's going to decay much faster, accelerate theta decay. Now what we'll typically do is we'll potentially, if we hit our target at 105, there's going to be a nice profit. But if it doesn't hit the 105, we keep the premium that we got for selling at 105. That's going to amortize down the long dated, in this example, the 6th June, reduce the cost of that trade, and then we sell the next series. We would sell the next series out, the 19 May or whatever that is, right? So we just keep doing it over and over and over like a covered call, and we're amortizing down our long dated. So that's the basic concept of it. It looks like a call debit spread, but we're two different option series for the long dated versus the short dated. So let's take a look at some different examples to kind of, so you can kind of get a better idea of how these really work and play out. So we're going to look at vertical debit spread. We're going to look at the butterfly, long condor, income calendar, calendar diagonal. We're going to look at a bunch of different examples here. And these are based on alert trades. These were trades for, you know, sent out with the alert service that I have. So here's just an example of a put debit spread on QQQ. And this was set up like on the 11th of May. And at that time it was traded 298.30. So very short in and out of trade actually. So the next day was profit take on the 11th and 12th, and it traded down to 286. So this is the alert. Just won't go through it in too great a detail, but you can see here it says here, let's see here. This is started out as a put debit spread where we are long the QQQ 13 May 298, put short the 290 put around 295. And then we were looking to later convert this to butterfly on any move lower to reduce the risk. So these are things that we can do. Now on the 11th, then this thing was now, you know, it was trading at 298 when we set up. Now it's trading at 291. So it really fell down hard. So yeah, this thing was up over $175 per spread. So you could, you know, set an alert to take profit. And then the other thing we could do, we could adjust. What we did with this one, we adjusted into a butterfly. All right, so these are things that we can do to reduce our risk, stay with the trade, and then actually potentially increase the potential profit of the trade because of the spread that we just created, plus reducing the theta cost. So here's the debit spread. It was set up right here. And it was traded at 298. right in here. And so really had a big move down. And so then the next day it was trading right here, and then eventually it was down right down to this level here. So really had a big move down. So this was set up for targeting the expected move on the downside. And then on the 12th, it was traded at 286.48. So right there. So this was a great trade setup just from the debit spread. And we then did adjust this actually to a butterfly later on. So here's the trade setup initially right here. We set this up where we're long the 13-8 298, put short the 290. The spread cost of the debit cost was $280, $2.80. Now your max profit then would be your spread width of $8, okay, $8 spread width here, less your cost of your trade, $280. So that would be your potential profit of $6.26 was where the spread was going out. And so this was up $346 per spread, 124% return. That's where it was trading on the 12th. So let's go through the trade and show you what that looks like on the risk profile. So here it was on the 11th, trading at 298. Then it was down, trading on the 12th to 286.48. So it was really fell down hard, and it was trading right here. And so the spread went from 280 was our cost. Now it was trading at that spread had widened out to 626. And so we were up $346 per spread on that risk of 280. So there's your return of 124% return. That was one day. And then this also gives us the flexibility. If we wanted to adjust this, we can make it into put Condor. We can make it into butterfly, a lot of different things we can do with the spread to reduce the risk of it, reduce the theta, and play for a bigger move down with a bigger potential return on our capital. So that's an example just of a simple put debit spread for a downside move. Now here's the wide wing butterfly. So the wide wing butterfly is great because it's going to give you a wider profit zone. So when you're looking at butterflies, if you're thinking about catching a butterfly, the bigger your net, the easier it'll be to catch a butterfly. So we can also do the same thing with the butterfly spread width. So the wider the spread width, the wider our profit zone. So that's the great thing there. So yeah, the debit spread is a typical setup for a downside move. We can start out with a put debit spread. Then if we wanted to adjust it, we could make it into a put butterfly, or we could make it into a put condor, things like that. So that's a really great way to start and leg into, you know, either a butterfly or a condor to reduce our risk and reduce theta. So here's the butterfly though. So again, this is structured for defined risk and hedging, great for kind of targeted directional swing trades, great for what we call pinning trades. So at an expiration, let's say there's a $100 strike and there's a lot of option activity there, and you think that the price could maybe go out at expiration at 100, we can target the 100 using a butterfly, and the body of the butterfly then typically would be the target of 100 in that example. So great for high volatility markets because we can reduce the risk really small with butterflies. So if we've got a market that's really going up and down big ranges, you know, you want to keep your risk tight. So this one way to do it is with the butterflies, so we can really reduce our risk, but still have a potential high return on that lowered risk. Also, the volatility of your stock is when volatility goes up, we're getting more premium for the short strikes of the butterfly that we're selling. Trade duration, we can set these up for 1 day or maybe out to 2 weeks. It's kind of the max out that you want to do. Going to always have positive theta, give you returns of 2 to 1 to 10 to 1 or higher in some examples or some situations. So again, of all the different option spreads, this will give you the biggest potential return on your spread. So here's an example of Microsoft butterfly spread. So this was on the 29th of March. It was traded at 280.40. And we were looking for a directional move targeting up to 290. All right, so we set this butterfly up. So the max risk was $73 per spread. And potential profit would be on the expiration of the 6th April. So that this had a potential to make, if we went out at our target strike at 290, which I'll show you, on the expiration day of the 6th of April, this would be up $427 on that risk of 73. That's a 585% return or risking $1 to make $5.85. So here's the original trade setup. This was doing a butterfly. We were targeting 290. Okay, so we went out and did the butterfly, bought the 285, 290, 295 butterfly, $75. That was the alert sent out. And then we had the 31st, we had some profit take, and then we had some more profit take here. So it was up 60, and then at expiration, it went out almost max profit on this Microsoft trade. So let's go through how this worked out and what it looks like if I can get rid of my drawing pen. All right, so here's the initial trade setup when we started. It was right here on the 29th of March, right there. All right, so we had our markets we were looking for a breakout up here. We were targeting into this kind of 290 area right there. All right, so we set the butterfly, and that was our target, 290. So then we had profit take on the 31st. It was trading at 287.61, pretty close to 290. And then on expiration on the 6th, it was trading at 291.76. So it jumped up. It was trading a little bit above 290, but was very, very close to max profit. But the really big thing here is that the total cost of the trade was $73. So you can see if you're really in an extreme high volatility market and you want to reduce your risk, this is a great way to do it through the use of a butterfly or even the long condor. So let's take a look at how this went out on the trade. So here it was, the spread we were targeting 290 was the target. So we did that as the body of the butterfly. So we're long the 285, short the 290, short the 290, long the 295. So $5 wide spread, cost of the trade 73 bucks, $73 per spread. So theoretically, if it went out perfect at that butterfly target of 290, this would be at $427 or 585% return. So, max potential profit. Now, you'll never get it perfect because it's hard to thread that needle, but you can get it pretty close a lot of times. So this is where the trade started. Now, here it was on the 31st, it was trading right here at 287.62. So this spread is $73, but look at this. So that went from 73 to $1.37. The spread blew out, increased. So that's a $64 profit right there on your risk of 73. That's an 87% return in 3 days. I mean, that's still a great return, right? 87% on your risk of $73. So not bad. And it still had the potential upside if it got here at expiration to make all this money in here, right? So these are great for kind of scaling out. You take a little bit, you hold it, and you try to get into the expiration where all this black area is what's left of potential profit. And that's based on your time and your volatility price component still in the spread, which hasn't been sucked out. Now here it was on expiration. So you can see this thing had overshot and was trading at 291.76, but it went from 73. Now it was up to $324. And so there's your profit of $251 or 343% return in 8 days. So these are a great trade. You just start scaling out and you leave a little bit, you hit a chip, you singles, doubles, and eventually potentially hit kind of more of a home run with these types of butterflies. But if you're wrong, your trading risk was $73. So you can easily absorb that loss and live to trade another day versus having a bigger, amount of money that you're putting up at risk. So target means if we're targeting this trade, we have a price target. And before we ever put up any trade on, I do what I call price target analysis. So we're looking at, okay, where do we think the price can go? All right, so we're going to base the price target based on a number of different things. We're going to look at Fibonacci levels, option activity, expected move level, moving average level. So in this example, we were looking for a target move to 290. There was a lot of option activity at the 290 strike. So we were looking for it to potentially pin at 290 because of a lot of option activity at that strike on the 6 April option series. So that's what we call a target. So that initial trade. So you have to have a target in order to set these trades up. You don't just blindly set them up. You have to have a kind of theoretical target, and these are based on a number of conditions, which I'll talk about a little bit later. All right, so that's the butterfly example. Now here's an example of the long condor debit spread. So again, kind of like the butterfly, but what this is going to do is going to widen out the profit zone. So instead of having to really thread that needle, you know, like a butterfly, we're going to widen out the profit zone. So we've got a bigger zone of profit. You know, we don't have to be exact perfect, but these are also great for hedging, again, defined risk, positive data, trade duration. These can be 1 to 3 weeks out. Typical returns could be 1.5 to 1 to maybe 4 to 1. Now your butterfly again is going to give you the biggest return, but these can give you a nicer, bigger profit zone to work with. All right, so that's what we call the long condor. So different from a iron condor. The iron condor is just 2 credit spreads, and that's your max profit. The long condor is a debit spread with the credit spread, so you're going to have much bigger positive risk ratio returns. So here's an example of one that we set up and legged into it. So this was what we did on the 6th. It was traded at 177. So we initially traded or set this trade up for a debit cost of $55 per spread. So if you look here, I'll try to walk you through it. So this was initially set up buying a vertical call debit spread, the 177, 179 at 95 bucks. And then in the alert, you can see we'll look to adjust to long call condor. We were looking for a move up, and then if we got a move up, we could adjust to condor, reducing that risk. So the same day on the 6th, it did move up. So it was initially traded 176.78. Now it's traded at 177.33. So what we did here was we adjusted this to a long call condor by selling the 179 call, buying the selling the 183, buying the 185 call. So we had a call debit spread, and then we sold the bear call credit spread there. All right. Okay, so that created a condor, and now our risk on this trade had adjusted down to $55. Now, what happened on this trade? The market started moving real high, so we had to adjust our short strike. So we had to go from 183. We rolled that strike up to 186, 189. So that cost us a little bit more, but the end result was we had a long call condor, what we call a broken wing condor, for a max risk of 68 and a potential profit of 132 on that risk of 68. So let me try to walk through the trade with you on this. So here's the initial trade set up right here. All right, so it's a breakout trade right there. So we had then a move up to this area here. So when it broke out that day, we had initially set it up as the condor, but then when it broke up here, we had to adjust the short strikes up. So this is kind of what happened. We ended up adjusting this to what we call a broken wing long condor. So it was trading at 182.15, and then we took profit on the 12th. It was trading at 182.28. So let's go through this one here and kind of show you how it was pieced together. So this was what the risk profile looked like, and trade at 182.15. We had a profit take on the 12th. It was traded at 182.28. So what we ended up with was long the 177 call, short the 179 call. So we had this call debit spread like this. Then we adjusted up and we sold out of the money 186, 189 bear call credit spread right there like that, right? So we had this long call, short call, then we widened the spread out, and then we short that call, long that call. So that's the spread. So long the 177, 179, $2 wide, and then we had this $3 wide right here. All right, now our adjusted cost though was 68 bucks, still very low risk cost trade. And the potential profit was the 200 spread width less your 68. So if it went out inside the spreads right there, this would make $132 on that risk of 68 or 194% return. So that's kind of the look there. So a lot of different flexibility and things we can do with these types of spreads. So here it was going out on the 12th. It was trading right here at 182.28. So this went from $68, the adjusted spread cost, 68. And now it was trading right here at 182.28. So now that spread had moved out to 169. And so that was a profit of $101. Okay, 169 less your cost of 68. So 101 profit on that risk of 68, 149% return. So that's what that looks like, you know, from that particular example of this one being actually a broken wing condor. Now here's an example of an income calendar spread on XRT. So this is the retail ETF. And with this one, we were doing this as kind of a target trade. So structured for very low risk. These are really great for very low risk type trades, the calendar. And with this market where we've been having so many different, every day there's almost a new number. So we wanted to keep a lot of these trades very low risk, and the calendar is a great way to do it because of all the different uncertainty to the market. So this is also though taking advantage of like a credit spread, selling time and volatility. So we're using these as a kind of a directional target trade for getting income, and also if we want to adjust for a bigger move up or down, we can do that. Going to give you a positive theta, no time decay. These are debit cost trade. So here's the one that we did on the retail ETF XRT. So this was set up on the 23rd, and XRT was trading at 67.74, and we were looking for just a target down to 66. All right, so just a real small move, but you'll see how cheap these can be. So we were targeting 66. So we were looking at support at 66. So initial trade was buying the calendar. So we went out and bought the 10 March and sold against the 23 February 66 put calendar. So at $99 or lower. All right. So basically long the 10 March 66 put, short the 24 66. So we're just looking for a move down to 66. Not a big move, $1.74 down, not much of a move at all. And so then you can see on the 24th, just the next day, now it's trading at 66. So we're hitting our target. And so this was, you could take profit on the trade, and then we were looking to adjust the balance. So a lot of things we can do with this other than just a pure calendar. So we did this as a pure calendar, took profit, and then adjusted the balance. So here it was trading, going in here, right here, you can see the chart. Trading right here, we're targeting right here to 66, and we hit that target just the next day at 66. So this was up about $44 per spread on that risk of 90. So let's take a look. And then if we didn't get it right, we have time to roll and adjust the trade. So you can see here what it looked like. So we're long that 10 March 66 put, short against the 24 February 66. The trade cost $99. Now the next day it was trading here at 66.13 right there. So this trade went from 99, that spread blew out to 144 or 143, and now we're up $44 per spread, or on that risk of 99, so 44% return in one day. So kind of like a credit spread, but this also gives us the flexibility. So if we thought the market was going to keep going down, we could have closed out that 24 Feb 66 put, and we could have adjusted and sold the next series. We could have maybe sold the 65 put against it. So now we'd have a 66, 65 put counter diagonal. So just a lot of flexibility with the trade. But this was just as a pure calendar, up $44 or 44% return one day later. Now here's an example of the put counter diagonal. This was a really great trade. And when the market was really moving hard to the downside, this was one that was one of our go-to favorites, using either QQQ or the Russell or SPY. So this is a put counter diagonal spread. Again, structure for defined risk. You're selling time and volatility. Great for getting paid while you wait. So we can do this trade, and if we think the market's going to continue trending down, we can keep adjusting for bigger downside targets. So when we initially set this trade up, let me show you and walk you through it. So it was traded at 177.67. All right, so we went out, we did this trade where we're long the 23 December and then short the 16 December. We're long the 178 put, short the 174 put at $2.40 around that area. All right, so we're long at 23 December 178, short the 174. So 278 long put, short the 274. So what happened with this trade and what made it really profitable was the market cratered to the downside. And you can see just the next day, now it's trading at 174. So when we set the trade up, it was trading at 177.67. The next day, it's trading at 174. All right, so what we did was we sold to close that 178 put that we had long originally, had a big, huge profit on that. All right, so we sold it, closed that, took a big profit on that. And then we stayed with the same series, the 23 December series, and we bought the 174 put. So we were originally at 278, market craters to the downside. Now it's trading out here at about 274. So we took profit on that 278 put, and now we opened up the 274 put. So now we're long the 274 put, but then we sold, we closed out the 16 short put the 174, and we sold to open the 19 December 172 put. All right, so we now have, this is 174. That was 178, had that different strike. So now we're long the 174 put and short the 172 put. All right, so we just rolled the spread down, but we had a huge profit, which turned this into actually a free no cost trade. And with a big, huge winner, and then if the market continued going down, we had a big potential upside profit or downside profit. So here was, what it looked like, and had a huge move down. So it's trading right here when we initially set it up. Next day, it cratered to here. So we adjusted this by, again, taking the profit, buying to close the 178 put, and then sell the 174 put, and then buying the 172 put against it. So now we have that 174, 172 versus when we originally set it up, it was 178, 174. Okay, so there it was there, and then we had profit taken there. So this was a huge winner because of the big move down initially, and this was a home run trade basically on this one. So you'll see what this looks like. So here's what the curve looked like, and you'll see this down here. It says $65 credit. So when this went from 178 crater down to 174, we took the big profit on that 178 put, and that adjusted cost made us into a credit of 65. So now we had no risk to the downside. And if it went up, went down, we still make $65. Now, this went out, we took profit on the balance here on the 19th. It was trading at 170, 173 right here. So this was up $316 on zero risk. So that's on per spread. So that's what that looks like. So just a lot of different things you can do once you understand these concepts. So, options are my favorite trading vehicle for trading all markets and market conditions. But today, I only had enough time to kind of scratch the surface of all their amazing trading benefits. So let's discuss, some steps that you can take now and to actually master the fantastic trading benefits of options. So next weekend, the 13th of May, I'm going to be doing what I call my ultimate option guide strategy course of when and how to use which strategy for the best results. So this will be next Saturday, the 13th of May. We'll start part 1 at 11 a.m. to 2 p.m. Eastern, and then we'll finish up on Monday night with part 2 from 4 p.m. to 6 p.m. And so I've got 2 great packages with 9 enrollment bonuses. So let me give you the link here real quick, and then we'll go through all the details of the course and all the bonuses and everything that you're going to learn and everything you're going to see. So use this link here, and you should be able just to click on it right here. Let me send that to you. So powercycletrading.com/guide, click on that, and this should pull up a payment link here. Let me see if that's pulling up. Come on, let's pull that up. All right, so yeah, So that's going to pull up a payment link here. You'll see here, right here. So you've got right here, the Ultimate Option Guide course, $197. So you're going to get the live course, trading indicators, course bonuses, handouts, and you're going to get 30-day trial membership. So let's go through the details of the course here in this package, course package 1. So that's going to be powercycletrading.com/guide, and this is $197. So with this package, this is everything you're going to get. You're going to get access to the 5+ hour course. Then you're going to start with, right away, we're going to send you the Option Masters course I did last go around. So it's recorded on demand. So if you want to get started before next Saturday, you're have the benefit to do that. So this is, if you go to my website, you'll see that this is for sale for $597. So you're going to get that to start right away, and then you're going to get my Fibonacci price target mapping. So there's a question of how do you set your price target? So this is a course that I did on what I call price target mapping, and this is specifically for targeting your profit targets and for your defense targets for stop loss levels and where you defend a trade. So you're going to get this course as a bonus. So this is for on my website, $397. Then you're going to get my other option course, Get Started Trading Options Today, kind of a more intermediate beginner's course. You're going to get that as a bonus. That's $197 on my website. Then you're going to get 30-day trial membership to my trading club. Start this whenever you want. So that's $97. If you continue on, it's $97 a month. You're going to get my cycle reversal indicator, my extreme range band indicator. These are 2 directional trading indicator tools that we use for the trade setups. These are both $197 on my website. And then we'll do a follow-up Q&A, which will be on the Tuesday, the day after. You're going to get my option trading tutorial, another option guide with tutorial videos on the option Greeks, $197, and then my strategy guide, 15 other option strategies for $47. So everything here, total over $3,600. You'll get everything here for $197, and these are, this is yours, forever, as long as you want the course material, even if you don't stay on as a member. Okay, so that's what you're going to get there. Now, if you want to have this with the alert service, then I've got that available to you in this package too, and there's a 2-pay. So use this link if you'd like this added with the alert service that I send out. So here's the link there. Just click on that powercycletrading.com/alert guide, and this will pull up your payment link here, and you'll get everything in course package 1, but you'll also get the alert services for the next 4 months and plus the trading club for the next 4 months. Now you can stop and start this whenever you want. So if you go on vacation for a week or 2 weeks, if you want to stop your time, you can start and stop whenever you like. So you'll get everything in package 1, but you're going to get the alert services for 4 months plus trading club for 4 months. And there's a 2-pay if you'd like to do 2-pay right here. Now, one other thing too, just to show you, if you want my trading indicators, you can get those as kind of an upsell here. If you want to add my momentum indicators to the package, those would be $195. So you can add those if you'd like. So those are the course price links there. And let's go through what you're going to get on this. So with this package, again, here's the link. All right, so you're going to get everything in course package 1, but you're going to get my 4 trade alert services for the next 4 months, plus the trading club for 4 months, and everything in course package 1. So with this, you'll get whatever, if I send out a butterfly along condor trade alerts, you would get that. Or if I do a counter diagonals, you would get that alert. Or an earnings trade, you would get that trade. Or breakout reversal trades. These are debit spreads or credit spreads. So 4 different types of trade alerts that I send out, depending on the market condition, the cycles, etc. So everything here for 4 months, 4 months trading club, all the bonuses in package 1. So this is a total cost of $597, and there's a 2-pay. So if you look at that, it's basically $400. So you're basically getting alerts for $100 a month. And so, that's a super, super cheap deal. If you look at that and amortize it, $400 a month, and if that was on a daily basis, what is that? $100 a month divided by, let's say 30 days, you're talking about $3 a day. So, you know, a cup of coffee. So that's what you're going to get there, course package 2. So again, 4 months to the alert service, 4 months to the trading club, everything in the live course, all the bonuses, and then these 4 alert services. And you can stop and start whenever you want on the alerts. You know, like I said, if you go out for a vacation or whatever, and you want to take a week or 2 weeks off, then you know, start, stop, and come back. So you're going to get weekly Q&A every week for the next 4 months, daily video newsletter for the next 4 months. So I do a video newsletter after the close every day, so you'll have that for the next 4 months. Now, if you do the 30-day trial, you'll get all of this for the next 1 month. So Q&A for the next every Tuesday, newsletter, my video newsletter every day after the close for the next month. If you do the alert service for 4 months, access virtual trading room. So I have a virtual trading room open each day during the day, 9:30 to 10:30 Eastern. So you have that access for the next 4 months with the alert service, or 1 month if you do 30 days, and 60% discounts on all course and software. So with the alert service, these markets have been really difficult over the last few months because we almost have a different number every day, but we maintain a pretty good reliability factor on the alerts. So we've had, since starting all 4 alert services back in 2018 to Friday, we've had 599 closed out, 446 winners, 36 break even, 117 loser, 80% reliability probability trades on those on the alerts so far to date. Now for the course though, we'll start this next Saturday, the 13th. It'll be live but recorded, so if you miss parts of it or whatever, everything will be recorded and then broken down in modules of 30 minutes or less. And so with the course, this is everything we'll go through. Let me give you, here's the link again, Sarah. This is for the course package 1. Use this link here. All right, so we're going to start off. I like to start with the Greeks. Make sure you understand the Greeks and how they're going to be used for giving you a trading edge for these types of trades. Then more detail on option pricing, how it works for, you know, setting up your best option strategy based on the option pricing. How to use standard deviation to give you the probability trade analysis you need to establish your price forecast that you need for targets and for your stop loss levels. So a big part of the course here is price forecasting. So we'll go through that, how that works. How to use your option delta trade probabilities to give you these probability statistics to use real quick. And then how, why, and when to take advantage of your volatility and what we call volatility skew, what that is, how to use that to benefit for your trade. So a lot of stuff you're going to learn about options in general. And then we'll go through the option strategy guide. So this is going to be the process that kind of I briefly touched on of selecting which strategy to use and then when to use it based on the market cycle you're trading, what the market environment you're in, what kind of the range of uncertainty you're trading, the chart pattern that we're trading. So we'll go through the chart patterns, what those are, how those are used as well. And then what's the best option selling strategy, what they are, how to use them. What's the best buying strategy, what they are, how to use them. And then we're going to go in great detail the option butterfly and its amazing trading advantages that you get for high volatility markets of selling time volatility and for hedging. So this strategy is one that can provide you returns of 100% up to over 1,000% with the butterfly. So they're very amazing. So we'll go through the butterfly strategy, when and how to use it for the different market condition, you know, you're trading. So the major trading advantages then of the long option condor spread, which is similar to the butterfly, very low defined risk, capital at risk strategy. So this is what I call my first step to go to hedging. So when we go through the hedging process, this is the typical, we'll try to hedge first, going into the long option condor. And then if we need to hedge more, we'll go into the butterfly hedge. So how, why, and when then to use the long condor spread for your directional trades, either up or down using puts or calls. So these are the kind of my favorite go-to strategies. We're going to cover every one of them in this course, and then when, why, and how to use them. The next one is such an important one that we use so much is the calendar spread. So this is again kind of a timing income spread, and so when to use this for kind of these directional target trades that I talked about. and then into the counter diagonal spread. So another really favorite medium to long-term trend trade. So how the counter diagonal spread works to create market neutral and a directional trade, giving you defined risk for income and potential big profits from your market direction. How this option strategy works based on capturing time decay without sacrificing directional speculation. And then how to structure this for, take advantage of the difference in your implied volatility between your short dated and long dated. So what we call the skew. So a lot of stuff you're going to learn in this course, and then how, why, and when to use these two strategies. So then we're going to go to these option strategies more in depth. So you're going to come out knowing exactly how to use all these strategies. So buying and selling options, vertical debit spread, calls and puts, butterfly long condors, counter diagonals, and then the hedging part. So how, why, and when to hedge, progressions of hedging using these options trades, risk management, how you can adjust to reduce your position risk using options, and then how to trade into a free trade, step-by-step guide of how that works and what you're looking for there. Then you'll get another resource chapter, assignment risk, expiration risk, auto exercise assignment, and a trade library. So a very extensive course and a lot of great information and detail. And then you're going to learn how to use these spreads and master these spreads in the course. Well, the trading club is the alert service is different from the trading club. Okay, so question is, I don't understand the trading club. So the alerts I just send out text alerts. Here's what they look like. So here, the alert service, you'll get we use a service called Telegram, and these are just the alerts. Here's what we did on Friday. New Oracle long traded at 96.90. Here it says buy the long, the 26 May 97 call, short the 12 May 99 call. So that was the alert sent out Friday. So that's just the pure alerts. Now, with what you're going to get additionally is the trading club, which is access to the trading room for every day during the week that you have access to. The Q&As that I do every Tuesday that are live recorded, you'll have access to those for the next 4 months. Discounts, anything on my website, you'll get 60% off on anything on my website. And so you'll get that as part of the trading club benefit. So you get that for the next 6 months. And so you look at all these different benefits, those are, and then I've got a educational vault. So if you go to my powercycletrading.com and you want to buy any of my other trading courses or software, you just come in here, and if you want to say buy my volatility breakout scanner, you can buy that. You come down here, and as a member, you put your members code in, and this is $397, but you do it as a members lot. You do your members code, and you'll get 60% off of that price. All right, so that gives you these benefits. So here you put in your promo code, your membership code, and this will knock off 60% of that price. So those are the things that you're going to get as one benefit. All right. So here's a little bit of feedback. Hope I explained that okay. So here's from one of my members that took the course. It just finished the master's course, loved it. Hedging on demand is a great game changer and allows one to enter trades with confidence. Already 2 of my probability trades, which were heading to my short strikes, were converted to butterflies, which I exited at a higher profit than the original trade forecasted. Slept much better, and the funds were reinvested. Compound interest is a little magic seldom mentioned with options. Now here are your enrollment bonuses that you're going to get, and let's go through those, and then we'll take questions on anything else you'd like. So you're going to get my recorded option master's course, so you can start right away with this 6-hour comprehensive course. So very, very detailed course, the on-demand option master's course from A to Z. So it goes through the different option strategies, all the different Greeks, etc. So this is yours forever, but you can start off with this right away. So that's bonus 1. Then you're going to get bonus 2, and this is where we use what I call price target mapping. So this is a really critical part of all trade setups. And so this is based on mapping out where you think price is going to go up or down based on price target mapping. And this is using Fibonacci analysis, moving averages, trend line analysis, price action support resistance, standard deviation price forecasting, unusual option activity. So this course, a 3+ hour course that takes you through this process of setting profit targets and defense targets using this process. So you get that as a bonus. And this is on my website for $397 if you went to that at $397. All right, so if you wanted to buy this on the website, you could get 60% off, but this is part of the bonus. Bonus special 3, get started trading options. So this is a kind of intermediate beginners option course that you're going to get. And so this goes through a comprehensive, easy to understand option trading course for the benefits of options versus stocks. Option basics you need to know, mastery puts versus calls, how option expiration works, and then a beginner strategy, covered call, and then I go through another strategy, the income protective collar strategy in this course. So this is just another kind of bonus course for you to get you started. And then you're going to get the trading club. So this is 30-day trial membership. And again, you can start this when you want, but here's the difference in the trading club versus the alert service. So with this, you get the access to my virtual trading room. So every day during the week, 9:30, 10:30 Eastern, Monday through Friday. Then after the market close, every day after the video, nightly close, I do an updated video newsletter, kind of my take on the market, what we're looking at, what happened in the market during that day. Your trades are video archived. Then we do a live Q&A, typically every Tuesday, live and recorded. You get access to Traders Education Vault, some good educational material, and 60% discounts on all courses and trading software. And so you get this for the next 30 days free. Now, if you want to go on, it's $97 a month, or you can do an annual membership or something like that, So, but this is just a trial, so you can get started, and a really nice service there. Then you're going to get my cycle reversal indicator. This is a really great tool that we use for showing us when market cycles are changing up or down. So it's based on a percentage range band indicator I developed, and it also measures overbought, oversold. So it has an upper and lower study that we're going to use in the indicator. And the lower study shows overbought, oversold conditions, and the upper study shows cycle high reversals up or down. So you can see here, this is starting to cycle up. Here's one that's starting to cycle down, that arrow there. And so this is available for Thinkorswim, TradeStation, and TradingView. So you can have one or all of those. So this is a really forward-looking indicator that we use for all the cycles, changing cycles. And so we'll go through in the course how to use this as well. So here's what it looks like on Thinkorswim, just to give you an idea, a little bit more detail. Here's a cycle reversal to the upside. You see the reversal here, and then you get the arrow signaling that reversal up right there. All right, so that's Thinkorswim. Here's just another screenshot of TradingView to see. Here's the cycle reversal here of TradingView. And then you're going to get my extreme range band indicator. And this is another one that we use quite a bit. So when prices get too extended from their mean, so we get to areas where things are too extended and you have potentially buying exhaustion or selling exhaustion, this is the first start of a potential change in cycle. So the first signal that a security is about starting to reverse. So very accurate in signaling in advance potential cycle swings that are starting to fail up or down. So you'll get that. That's available in Thinkorswim, TradeStation, eSignal, NinjaTrader. And so it's based on what we call average true range. And so these are extreme range bands. We'll go through how this is used in the course as well. So you can see here was QQQ, just an example. Really extended up here over this 3 ATR line there, and then we had a cycle reversal, and then it starts to kind of pull back. Here's another one right here. Here's another one right here. Here's one to the upside. So you'll get that indicator tool as a bonus as well. And in bonus 7, we'll do a follow-up live Q&A. This will be the Tuesday after the course. And so then you're going to get 30-day trial membership for your additional support there. So come in the trade room, ask questions, whatever you have a question on a trade or anything, please feel free to come in and ask questions. And then you're getting my option trading tutorial, the 60-page option guide of the Greeks with videos and a 60-page guide going through, again, the Greeks delta, gamma, theta, option pricing, standard deviation, option delta. So just another option tutorial for you. And then last but not least, top 15 option strategies. Here's just another guide what is a ratio what is a ratio spread? What is a unbalanced ratio butterfly? So just another option strategy guide for you to put to your option library. So that's all the different alert bonuses there. And then we've got the alert service here again. You'll get the 4 months to all 4 of the different alerts, 4 months to the trading club. So alerts on any earnings trades I sent out, breakout or reversals, calendars, butterflies, long condors, and then everything in the package 1. And all this is for you for $5.97 or 2Pay if you'd like to use that. How do you do annual membership for the alert service? Don't see any options on the website. This is not offered on the website. So if you're going to do the alert service, you can only get it through today on this package. I don't offer it through the website. So it's just kind of a very specialized thing that I offer out with courses, okay? All right, so if you'd like to get the alert service, then use this link again. And the thing is, you're going to get not only what are you going to get the alert service, but you're going to get this course, all the bonuses that I showed you, plus the alert service for the next 4 months. Now, if you decide to stay on after 4 months, typically I'll grandfather you in and you can just adjust based on what that cost was. Oh, thanks, KM. Wow, let me pass that on. This is from KM. Thank you so much for passing that on. Let me add this to kind of a testimonial. Thank you so much. Yeah, so Kenneth, yeah, so I go through step 1 to evaluate the current market, and we'll go through that in the course, how to evaluate the various market conditions you're trading in. Yeah, so also then another question, will you be able to discuss which strategies are working best in the current market? Yeah, exactly. That's the purpose of the course. Yeah, so sure. Here, Ross, use this right here. 1 second here. Please do. All right. Okay, so this is from Dan. Just recently came in. This he sent me this. He said, "You're very diligent and totally thorough with your analysis. That is the foundation of the success of the alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with your other participants." And this was from Scott, one of my old members. Said, "It'll be the best investment that you'll ever make. Go with the elite package, great group of traders, and the trading club too." So with the alert service, you're going to get some members just do their own thing. They just want the trade setups, right? They just want me to send out, whatever the trade is. I'll show you the one that I sent out Friday was Oracle. But with this, I'll also always give you a suggested option trade. So I'll give you the entry level profit targets based on, the option target, the target pricing analysis that I do. So I'll give you the price targets, for profit targets, stop loss levels, etc., using this Fibonacci target analysis. What option series to use, stop loss levels, guidelines, trades are listed and archived, okay? And then after the close, if we do an alert trade, I'll go through a trading setup video of that trade, what was done, what we're looking for, for the trade. And then with the trading alert service, you get the trading club for the next 4 months as well. So this gives you access to my daily video newsletter every day after the close. Gives you access to my weekly Q&As every Tuesday, live and recorded for the next 4 months. Access for virtual trading room every day during the week. You can come in 9:30 to 10:30 for the next 4 months. Discounts on all courses and software, 60% off the next 4 months, and educational ball. So here's the alert service aggregate there. So here's just a kind of a brief review of some of the ones we've done recently. This is the calendar diagonal. We do a lot of these because just the conditions of the market's kind of been dictating these trades. So since starting this back in June of 2019, we've had 203 trades closed out, 154 winners, 10 break even, 39 losers. These have been high winning percentage type trades. These are unaudited, but these are summary of the trades as we kind of go forward with them. So that's a look there. Here's what I showed you earlier. This was on XRT. This was the calendar that we set up, and this was just targeting down to 66. So set it up on the 23rd. The next day it hit our target, so we took profit there, 44 bucks or 44% return. So here's the IWM long put calendar diagonal. I showed you this one earlier. So this was the alert service there. Just crushed it to the downside, adjusted this to basically a free trade, and this was up $316. Just kind of give you an idea. Now here's the butterfly long condor alert services, and this is one that I started this back in May 2019. We've had 124 closed out, 92 winners, 6 break even, 26 losers, 79% winners. Now these will be all the potential at risk. These will be the lowest at risk trades, butterflies. So typically, you might be at risk by a stop out 50, 60, 70 bucks, something like that. But these have potential returns of 2 to 1, 4 to 1, or potentially up to 10 to 1 sometimes for the butterflies. Okay, so this is a combination of butterfly long condors in this alert service. And I showed you this one earlier. This was the Microsoft trade alert. So we set this up right here, targeting up here to that 290 strike. And so showed you this one earlier just to kind of flash through that. But this was one just done recently on Microsoft. And then here's XRT. This was the XRT trade that we initially started this with the put calendar, took profit, and then adjusted this to a free trade. So I'll show you what this ended up looking like. So we took profit on it, and then we adjusted this to a free trade on the 28th of February. So I'll just go through this real quick. So came down here, took profit there, right here, and then we adjusted it right here into a free trade. So basically, the trade was initially just to put condor, and then we adjusted the balance. So we ended up long the adjusted 10 March 66 put adjusted price of 70. And then we sold against it the 10 March 65 put, brought in 70 credits. So we had 0 cost now, right? And then we added to it a full put credit spread 64, 63, 17 credits. So in this trade, we ended up with a credit of $17. So no risk on this trade. And if it went out between our spreads, right here, this would make $117 on 0 risk, or actually a credit of $17. And so this is, the adjustment on that, what that looked like going out. So here was the initial trade going out right there on the 9th. It was traded at 64.53. So this was up, $69 per spread on 0 risk right here. So that was adjusted to that long put condor. So that's pretty much everything here. And thank you so much for adding that nice testimonial there, KM. Appreciate that. Any other questions here? Minimum trading account size. Well, these are low risk trades. So, I mean, $5,000, something like that. I mean, you could do it even with less than that. Oh, thanks so much, SS. Wow, thank you so much. Pass this on. This is fantastic. Thank you so much. I strive to give you the best trades and best education I can. That's really important to me. So this is just kind of really a great compliment that I just received. So let me, if I can get this. Hold on a second. 1 second here. Just trying to. If I can copy and paste this 1 second here. Thanks so much for this. Thank you very much, SS. Oh, thanks, KO. I'm not your top option mentor. Just kidding. This from KO. Yeah, you should be able to enroll in the alert service. Yeah, no problem. Just use that link I gave you, Ahad. Here, just use this link and this will enroll you in the alert service. So here's the package 2 for you. Just use this link here. All right, so that'll get you the alert service. And then here's course package 1. If anybody wants just course package 1. There you go. Yeah, if you want the 2-pay, just click on, it should just pull up the 2-pay right here. Just so if you want 2-pay, Roger, just go down here to right here and click on 2-pay, and you'll have 2 payments of $331. See that? So original, $597. If you want 2-pay, you can do it for 2 payments of $331. All right. Any other questions here? Again, thank you so much for everybody taking some time to be here today. Oh, yeah, the second payment will be, after, I believe it's 2 months later. All right. Well, again, thank you so much, everybody. No, not 2 days later. It's 2 payments. Did it say 2 days later? It should be just 2. Make sure. Yeah, it's in July. So the first payment will be today, and then the second payment says July. Yeah. See right here, right there. July 5th. Yeah, not 2 days later. Yeah, that I see what you're saying, a little confusing, but that's July 5th. Does that clarify that for you? All right. All right, so that's everything you're gonna get. It's a really great package, and I'm looking forward to seeing a bunch of you next Saturday, and everything will be recorded, and like I said,